Hello, hello, hello. Welcome now, Stock Trades. In this video, we're going to go ahead and do a intrinsic value calculation, price target analysis on the Honest Company, ticker symbol HNST. Now, if this is the first time you're tuning in and watching this channel, we've been investing in the market for 10 years, and we've been analyzing companies by taking a value investing approach and mixing a little bit of growth, Kathy Wood style type of looking at companies that can potentially disrupt markets, right? Um, the issue here is that by just looking at this company and just kind of doing a surface analysis and then a deep dive analysis, I can see that this is just another YouTube stupid stock company that was unfortunately pumped. And retail investors and other YouTubers that do not have any financial savviness or analysis basically pumped videos thinking that potential source is credible. But in this regards, we're going to go ahead and do an analysis, and we're going to go ahead and show you guys the financials of this company, and we'll conclude with a concluding statement, and then we'll go from there, and we'll give you a price target that we calculate directly. Okay, so if you look at the Honest Company here, and we're going to use numbers pre-IPO and post, and you can see that the growth here is going from 236 million to 312 million. So we're going to be going ahead and taking the growth rate of revenue to estimate the intrinsic value calculation, because if you look at the net income is negative. We're looking at negative 31, negative 14, negative 39, negative 45. The company is still in its negative form, and so far there isn't a path to profitability based off of the data that we have so far. Likewise, if you look at number of shares, there is some dilution, double dilution from this angle here of 34 million. I would call a little bit more than double here. Now we're at 92 million shares. If you look at book value is $1.68. Now, for people that don't understand book value is if I was to scrap this company right now and I was to go ahead and pay off all my debt, what would this company be worth in terms at bankruptcy filings? And this is at this standpoint, it is $1.68. The problem is once they continue burning cash, that number slowly goes down. The only time book value, and it's a really great metric to look at in terms of the health of the company, is if it's fundamentally sounding, where the fundamentals of the business generate enough capital and free cash flow that will undoubtedly increase the book value. Unfortunately, book value is trending down from this particular angle, and we're going to most likely see it trend down more given the current economic environment that we're in. If you look at free cash flow is still negative, and in fact, it's becoming more negative, and it's increasing in negativity. And so there's that in regards, right? And working capital, again, no change in working capital. So again, this is like a company that I would look at. I'm like, okay, great. And we would just basically scrap it. And I would be like, okay, I'm basically not going to go further from this. So I was asked about this company a while back ago, and it was on our list. And we got a couple of requests on YouTube. So we're like, okay, fine. I have a huge list, and this was in the top 10. So I pushed it up, and we're going to be doing an intrinsic value calculation. Now, normally I would not be doing an intrinsic value calculation because this was a complete waste of time. But for education on YouTube, we'll go ahead and do it. So we're going to go ahead and pull up our intrinsic value calculation software here. We're going to pull this up here. And this is a really nice intrinsic value because it goes ahead and projects different types of free cash flows based off of different discount rates to give you an approximate average of what the stock price should be trading at. So the thing is we're not going to be putting the stock price here. We're just going to be basically putting the fundamentals, the book value, essentially how the business has been performing. Okay, nothing about the stock. And I'm going to show you what I put in. So we're going to go ahead and we'll just, 2019, they made 236 million. 2020, they made 301 million. And by the way, that diagram I just showed you a couple minutes ago, I'm looking at it right now on the other screen so I can talk to you guys, right? 2021, they made 319, and then you can look at the TTM. They're at 312. Okay, So originally, from my understanding, people thought that this was a growth story. And as I'm talking to you guys, just let me just give you kind of not quantitative analysis, more of a qualitative analysis. Entering the space in terms of this cleaning products. Jessica Alba. Definitely, I believe she makes music. I've listened to some of her albums here. Um, the issue here, guys, is that they're trying to basically beat out Procter and Gamble and all these companies that and then not just that, they're trying to attack Walmart brands and Target brands, and this is just such a celebrity status can only get you so far, and welcome to the world of business. I don't care how many followers you have. The only people that I've seen that were able to successfully crack the code is honestly Kim Kardashian, the Kardashian family, in terms of using their celebrity status to sell products, and also the Yeezys, but nothing in the public arena where financials are exposed. So I'm, it's definitely a tough business to crack. But anywho, we're taking 5% of the revenue because we're going to be estimating the free cash flow. This is a trick that we like to do, because typically a good company would have a free cash flow of 5%. And if you were, and I haven't honestly checked, if you go ahead and look at the companies within I've analyzed thousands of companies. Typically it's 5% of the revenue, if not more, depending if it's a different type of business model. One thing that I do want to add before we do this analysis here is that if you look at gross margins are actually, pretty good. I would say 30% here. They would need to be a little higher, but not bad. There is a story here, and there is hope if they're able to turn this burning cash around. But we're gonna, the beautiful part about doing an intrinsic value calculation is that it helps protect you and tell you when they get in and when they get out. It gives you an understanding of what is the fair value of the stock. So let's go ahead and do 5% of the revenue, because now we're estimating what is the future free cash flow of the company when it does become uh, um, pro- profitable. So we're just going to put this here. It doesn't matter what year you put it in. It's just going to eventually take the average. So it doesn't matter. If you want access to this intrinsic value, there'll be a link down below, and our Black Friday coupon code sale on this biggest sale we have. So now we're going to go ahead and we're going to take 2019 and 2022 numbers, and then we're going to go ahead and estimate the short-term growth rate. So we're going to go ahead and do that here. They made a 236 million. 2022, they made around 312 million. That's around 10% growth rate there. Okay. And to be honest with you, it's actually growing lower than that. But we're going to go ahead and again, we want to take the big slope of their growth. We're going to push this out to 10 years, and we're going to discount back at a 10 to 15% discount rate. This is the estimated free cash flow of the company based off of 5% estimated free cash flow when the company becomes public. And now we're going to divide by the number of outstanding shares. And if you don't know this and understand this, we teach this type of analysis to help retail investors thrive in the stock market, because this is something that's not taught, and a lot of YouTubers that try to act like they know what they're talking about, and it's all facade, it's all smoke and mirrors, and it's all BS. And unfortunately, retail investors always get the short end of the stick. If you look at the shares here, we can divide by 92 million, because remember that number. And by doing that, we get a recession case of $1.17, a bear case of 202, a base case of 259, and a bull case of $3.55. Now, again, this is using a growth rate of 10%. And a lot of these investors were like, oh, yeah, 10% is great. And look at the stock price. Now, if you look at the stock price now, we're trading at $2.91. I mean, ladies and gentlemen, you can see how the intrinsic value calculation protects you from making stupid mistakes and buying in at the top. There are idiots out there that think they got a good deal buying in at around the $5 region. I mean, how stupid can you be? And again, this is not a channel here to I'm only calling people stupid if they try to act like they know what they're talking about and educating folks. That's just a complete moronic way. You can see here that this company was trading at some point $18, which is complete insanity. It's just complete insanity. If you actually were to want to look at the actual stock price here, the revenue is actually growing 2.33% year over year, And if you put that here, 2.33%, this is the actual value of the company, anywhere between 127 to 207. So I would say this company still has more to go down and more to decrease based off of this, but we're going to go ahead and give them 10% because that's what they grew on from 2019 to 2022. And you can see here, we're hovering technically right now near between the base and the bull case. And once a recession hits next year, this recession, I feel like it'll go down lower. If not, it'll go down lower sooner than what we expect. The macroeconomic environment, with inflation being so expensive, a lot of consumers are being stretched, and their dollar unfortunately is being taxed because their dollar is now more worthless, and now they're going to have to go to Walmart, and we've already seen that on the Walmart earnings. A lot of folks have given up purchasing electronics and non-essential items, and cut back on buying name brand. So these are all things that you need to basically analyze when it comes to these types of companies. Personally, I would never have even put these terrible numbers in my intrinsic value calculation because personally, I would have stopped based off of the financials. But again, this is an educational platform, so you can put anything you want in here, no worries. But it just gives you kind of an idea of kind of the red flags you can just basically see based off of the financials when you look at the balance sheet, income statement, and statement of cash flows, and derive a analysis, because the financials tell a story. If you like this video, consider subscribing, liking, commenting, and sharing. I would like to hear what you think. And yeah, it is always an honor and privilege to serve you guys, and I will see you on the next one.